evening and welcome to the next edition of Fire Up, the Startup Insights series, jointly by IIIT's CIE and Sucseed Innovation Fund. So today we have with us Vineeta Gupta. Vineeta has had a phenomenal career in the investment banking space for a long time, multiple companies, and working with VC firms and private equity funds and such, and now has joined Succeed Innovation Fund to lead all the investment activities as the investment manager for the fund. So Vineeta, thank you for joining us today.
Thanks, Ramesh, for having me.
So, yeah, and I think we could not have. I mean, we picked a topic for you in less than 2 seconds. We said, like, what better topic with somebody like you that's worked on the investment banker side, worked with startups, worked with PE funds. So, and the best thing we could think of is to kind of decode the whole startup valuations. Startup valuations, and then of course a big facet of valuations is the end exit. So that's what we're going to be discussing. So just to get started, Vineeta, what is startup's value? Let's start with just defining value. I mean, in subjective terms, what is startup's value?
So as Ramesh rightly said, to decode and decipher. So it is something which is not very simple, something which is not comes naturally to the founders. And there is a lot of confusion around, getting to the right value. So in simple terms, the value is what I'm ready to pay today for the future earnings. So whatever earnings a startup is going to generate in future, what is if I discount it to today's rate, what is the present value of that earnings? So if I say that, it sounds really simple, but now to predict the future is as complex as anything in the world we can imagine to be. So there are so many factors involved, not only internally to the startup, but also outside. So the market, the competition, the geography, the product market fit, how successful it is, how acceptable it is by the customers. So there is a lot which is external as well to the startup. So my idea is very internal, that I want to do this. So a founder is very passionate about what he can achieve, but he's not as passionate about at what value he should, what is the value that he should, give to this idea. So that's where a lot of confusion arises. And given that there are so many VCs and there are so many angel investors, everyone has his own favorite, or maybe they're using a combination of 2-3 valuation methods. So that's where, it gets very confusing for the founders to understand exactly how to value themselves. And especially given that the space we are in tech, many founders are not very cognizant with the financial terms, with what can be the present value, what is the IRR, what is the DCF. So that's where the whole confusion starts arising. So in this today, over next half an hour, we'll try and see how we can simplify, and how I can communicate with the founders to help them value themselves, to help them understand how they should look at when they're raising funds, how they should look at valuation. So simple terms, value is basically what you're going to earn in the future.
So it's a present, at some level, the present value of their future earnings.
Correct.
Net earnings. Either in terms of, it's an investment exit midway, or however they look at it, but at any point, it's the net current present value of future earnings. I think very few founders look at it that way. They look at it more saying, okay, like I can raise like 100 million in the next 3 years. Mm-hmm. So they don't understand that the next 3 years, 100 million also is at some level, the value of their future earnings from that point.
Yeah.
The present value, that's something that's often not, it's completely lost on founders, that it is at the end of the day revenue that matters.
Correct.
And so now how does the value translate into valuations? Subjective terms, yes, this is the value. Mm-hmm. How does it translate to valuation? Because valuation becomes a current hard number. So how does this value translate to valuation?
So valuation is, as I said, it's dependent on a lot of things. So to start with, I'll just list them down one by one. This is something that founders can then understand, that the valuation doesn't depend on one thing about how much they want to raise, but it depends on what are the current market conditions. So, given last 6 months, because of COVID, there have been so many disruptions in the way usual business is conducted. So you have to take into consideration the current market condition. In 2008 and 9, the markets were really at their bottom. At that time, if you go out, obviously you will not be able to raise at a good valuation. While if you're, raising in, let's say, 2019, it was like very good market. And even currently for startups, for the tech startups, the scene is really good. So it depends a lot on what is the current market condition. Then the second comes the founder's past records. Now, if a founder who has had multiple exits, who has had multiple, rounds of starting and then exiting, so when the track record is good, obviously the valuation will be higher compared to somebody who's just starting, somebody out of college, somebody who's, has had experience of 5-6 years on the job and really comes up with a brilliant idea and he wants to start. So past records also play a large, have a really large importance. The second is team. So why I say team is because you can't really run a one-man show. So somebody will be good at a product, somebody will be good at marketing, somebody will be good at understand, so keeping the whole organization together. He's a very personal friendly and motivating person. So the team also comes into play. Then because it's tech, we have to talk about IP. So if you have an intellectual property that you can really patent and you can talk about it, so that obviously will give you a big boost in the valuation. The fifth is traction. Now traction, when I say, is if you have 0 customers versus if you have 5 customers who are increasing their orders or who are increasing the engagement. So there'll be again a large difference between when you go to raise funding without any customer versus you have some traction and there is visibility of going ahead in the future. Then sixth is risk. Now risk can be multiple. It can be litigation risk. It can be, if you're going to expand into different geographies, then the international risk. It can be competition, how the competition is behaving. Maybe when you introduce, you had a very unique idea and there was no competition, but as the competition sees your product, they start updating their offerings as well. So how does the competition is adapting? So there are so many risks. We can keep on talking about it. So one factor is risk. The next factor is geographical location. So if you're a tech startup, you're starting in Silicon Valley, obviously you'll have a more valuation versus if you're a tech startup, let's say starting in Hyderabad or starting in even a smaller town in around Hyderabad. So location again has its own dynamic. Then the next is competition. Now, as I said again, how the competition is behaving, and you're not really doing something very different. You're just copying what the competition is already doing, and you're adding one feature. How quickly now competition adapts to that one feature, so that plays a part. Now, it might sound very, odd, but human psychology. How good investor is perceiving your passion, because it's all about when we are going to when a founder goes to an investor, the investor has to see that twinkle in the eye, literally, how passionate they are about the idea, and that also plays an important role. And I can add 15 more to the list, but basically these are the 9 to 10 factors which really go into doing any valuation.
So just to recap, so there's the founder's track record, there's the revenue, there's the risk, there's the geographic location, competition, passion, and the few more before founder track record that you touched upon.
There's team, and there is current market conditions. How relevant the global scenario is for a fundraising, from a fundraising perspective.
Present market conditions. Yeah. So that's a fantastic list to keep in view. Now, before we go into some of how valuation is done and what founders can do about valuation, where are, I mean, it's needed in some cases, right? Many cases, it's specifically, it's not just, so what are some places where definitely evaluation is needed?
So if you know this idea is such that you don't really require a lot of cash, it can be bootstrapped. It can be, you know, you can raise money by yourself. You already have earned, let's say you've had a 15-year experience, and you have enough cash reserves. You don't really need more funding. Then there's no point of valuation, because valuation at the end of the day is just a number which becomes relevant only when you're doing a fundraising. If you're not use that, so only during the fundraising process, I feel evaluation becomes relevant. Now that fundraising could be at different stages. It could be seed stage, it could be series A or BCD, or you're going public. So fundraising is again, you know, at different stages. And like all companies I've seen go through this, you know, life cycle, whether you call it the startup life cycle or the valuation life cycle, but they go through this life cycle of, and I can, you know, talk through that. So the first funding that any founder receives either is from self or friends and family. Now at this stage, the idea, you know, the founder has only a concept, there's only an idea. He doesn't really has, you know, tested the market or developed a product either. So at this stage, normally the fundraising is, you know, less than a crore, and I'm talking in INR here, because this, we are talking to Indian founders and we are talking to, you know, the Indian scenario. So typical fundraisers, you know, 10 lakh, maybe up to 50 lakh, or maybe in some cases when you need to spend a lot on the IP, it can go up to 1 crore. And the valuation at this stage is normally below 1 or maximum to 2 crores. So this is the first stage of funding.
And this stage, there is no, at least subsequent stages, there's some hard data that can be looked at. In
Absolutely.
this stage, there's no data. So often it's very, very, very subjective. At every stage, it's subjective at some level, but this stage is probably extremely subjective.
Absolutely.
Are there
Absolutely.
any thumb rules, like you did say 1 to 2 crores typically?
Yeah.
Are there any thumb rules on when is it 1 crore and when is it 2 crores?
So as I said, if there is a lot of money that is, let's say if I need to raise 1 crore to, you know, work that, because I'm going to take 1 year to develop this product, and that's going to, so if I'm going to work for 1 year and I need 1 crore funding, then I would value it at least at 2 crore. So even if I'm raising 1 crore, I have at least, you know, 50% stake. I mean, largely it is still you and your friends or family only. But you know, so it, and when it is an idea which, you know, you can develop over, let's say 1 month, then, you know, obviously you'll, and you don't need as much money in that, those cases the typical valuation would be 1 crore. So again, depending on, you know, if it's an enterprise SaaS kind of a business, or if it's like, let's say, you know, a fintech kind of business where you will need more funding to actually develop the product.
So there's some, I mean, if you just anecdotally look back at some of those, these are all pre-revenue investments. They definitely don't have revenue at that stage.
Yeah, even the product is really not out there. It is still at a concept stage. You have to spend that much time right now to build the product, to build an MVP. So this is
at this stage,
yes.
so typically they say, or not they say, moves happen at less than 10% valuation.
Correct.
Is that a good thumb rule? Like raising 20 lakhs, you should preferably be 2 crore valuation, so you give up 10%.
Absolutely, yeah.
So the 10% is one thumb rule for that stage. Whatever you do, you need the money you need, but it's 20 lakhs or 1 crore. Yeah. But typically it is 20% dilution. Correct. So that's some indicator for them. I mean, 10% dilution. Correct. Now, next was the angel stage. You're going to get to the angel stage.
Yeah, the angel stage, or we can also call it the seed stage. Because angel investors, you know, invest both at the seed stage. They can do a series A as well. So rather than investor centric, I'm just right now focusing more on the, you know, the funding stage. Yeah. So the second is the seed stage, where you have an MVP, a prototype, and so you have spent some, you know, time in developing that, and you typically don't want, let's say, more than, you know, 1 crore at this stage. Again, in some cases you might go up to 2-3 crores, but you're again raising that 40-50 lakh is the sweet spot here, what you're raising. And again, in this stage, you don't want to dilute more than 10%. If, you know, if you require more funding, if your product is, I mean, you really need that geographical expansion, you need to open more offices, or you need to have a larger team where you'll be funding them for, let's say, 6 months before the revenue actually starts flowing. In those cases, you might have to raise more, but you'll still, you know, try and do 10, maximum 20% dilution at this stage. So valuation in this stage is more, like, if the first stage was 1 to 2 crore, I would say this stage is 3 to 6 crore valuation.
Okay. And so seed stage is essentially pre-revenue.
Correct.
It is MVP, but no revenue.
Yeah, correct. Pre-revenue. The next comes Series A. That's where you're testing the market. So you have a product market fit stage is what this is called, and you have a couple of customers. And typically you want to raise 2 to 5 crore at this stage for expansion. And the typical valuation, I would say, in this stage would be between 10 to 50 crore. Again, 10 on the lower side and 50 crore on the higher side, depending on how fast the revenue is growing. If the revenue is doubling or tripling every month, then obviously your valuation will be higher than if it is growing by, let's say, 10%, 20%.
So in India, that is generally the angel round. 3 to 6 crores is generally the angel round. So they have some revenue. They've just kind of built the product, have some revenue, and they're now going to grow the revenue. So that's the stage. So which is typically 20%.
Correct. Yeah, which is
at most 10 to 20% dilution. Yeah.
Correct. 10 to 20% dilution. And, this is, okay, as I said, between seed and Series A, angel investors are present in both the cases. And from Series A onwards is where VCs come into picture.
So that is million upwards, 6-7 crores upwards.
Yeah, correct. Whether you're raising more than 6-7 crore is where. So these are not hard numbers. These are always a range. And again, multiple levels of players come into play in each of these scenarios. The next is Series B, where you're again, expanding and scaling up. You've had a customer success on your product market fit, and you are raising more than 5 crore at this stage, and your typical valuation will be in excess of 50 crore. So here the risk, and each of these stages also have a different kind of risk. So friends and family, it's an idea risk. You don't even know if the idea is worthwhile. Okay, the second stage is where it's a product risk. Seed stage and Series A stage is where it's a product risk, where you don't know if the product works, if it's acceptable to the market. The Series B onwards is a market risk, it's a customer risk, right? Because you want to understand how well the product is accepted, how so it's all about that stage is when the competition comes into play. So this is you really start getting noticed, and so is the product risk. The last, I'm not saying last, it can be onwards from there. So Series C or D, or you can go public as well. This is the valuation risk. Here, you already have great product. You have multiple revenue streams. You might be raising more than 50 crore because you want to go international, or you want to do, acquisitions at this time. So your typical valuation can be upwards of 250 or 300 crores. So this is, or you get acquired at this time. So this is, the place where it is no more a product risk, no more idea risk, but you have moved on to the valuation risk. You have crossed that stage, and now it's more about larger investors are looking at you, and you're getting noticed.
I think that's a very comprehensive view. Now, talking about value, what are some of the defense mechanisms that the startup might have to defend value? Like, obviously, the investor will say, like, startup says, I want to raise 2 crores, and I think my company is worth 20 crores. Mm-hmm. The investor will say, look, no way, it's max 10 crores, and we'll do 2 crores at 10 crores. Now, what could some of the things that the startup could use to say, like, okay, for these reasons, my value is higher than what you're telling? Both of them are subjective at some level. Yeah. Because it's not based on current data. It's all very speculative in nature, because current data doesn't justify that value. True. But it is, so what are some of the different mechanisms the startups could use to defend value?
Yeah. First, I'll just talk from both the perspective as if I'm, the third person here. So it's at that stage when, the startup wants more while the investor wants to pay less. It's really a tug of war at that stage. So, they're both pulling from each sides, and they're both discussing what is more valuable versus, who they're investor challenging and negotiating what is less right now. So it's that situation. But once the investment happens, then they're both on one team, and it has to be a win-win. So when you decide a valuation, it has to, from that point onwards, it has to become a win-win for both the investor and the founder. But in terms of, like, how a startup will defend or wants to wants to negotiate is one, the startup has to show that how unique the idea, how unique their concept is. If it's just a 10% change over what is already there out there, then obviously, the investor is going to beat him down. While if you show that this is a dramatic, a disruptive idea, so it is difficult for investors to accept that. Like, in case of, let's say, Airbnb, or in case of Uber had its first seed round at a $5 million valuation, and there are at least like 100 investors, angel investors, which refused Uber. And because they said it's a 3 million valuation, why you're asking for 5 million. So because it was really a disruptive idea, nobody wanted to had believed in, that this can work. And similarly is the case of Airbnb, or similarly is the case of, let's say, what Jio achieved. Airtel was already had good penetration, but still Jio went ahead, and not only did they break into Airtel, I mean, they expanded the market. Nobody was using as much data as we are before Jio started. So the founders need to prove how disruptive, how good the idea is. Then obviously there needs to be a strength shown in the management team. It can't, if it's a fresh student out of college, I will have my doubt. Versus while if you've spent time in the industry, you have had 5 to 6 years of experience, then that much more convincing it becomes. You show your knowledge of the industry, and that's how you earn your points. The next is, what are the strategic relationships? Now the strategic relationships can be on both sides. It can be on the supply side, and it can be on the demand side as well. So whether you have the suppliers relationship, or whether you have the customer relationship, so that again plays an important role. Again, this is the stage that we are discussing is a pre-revenue stage, so there's no data. So what we can see is how well connected, or how aware you are about the market. And there can be other things as well, but these are the three broad things that come to my mind.
So because this is something that often, because there's some indicator that says like, look, you can look at, say, as a good startup, maybe it's 10x of revenue.
Mm-hmm.
Now, for an early stage startup, even that revenue is not there.
Absolutely.
If there's good revenue happening, like you're going, like you're raising a couple of $1 million round, and you have some good revenue traction, you can. So even to say 10x of revenue, you have to show them that, look, I'm on a path where today my revenue is small, but in a year from now, this is my revenue that's going to be.
Absolutely.
So in a year, at 10x revenue, this will be my value.
Correct.
So work backwards, discount 20%, this should be my value today.
Correct.
Now, so these are all, I mean, I don't know what will work, right? But at some level, revenue projections can help. If you can convincingly project revenue, that can help in kind of convincing of a higher value. So strategic relationships also for that same reason. When you say strategic relationship, you're going to say, look, this is a demand side relationship, so it's going to get me revenue.
Mm-hmm.
And this is what they've assured. And they've already shown that it can happen. So those are things that give the confidence to the value.
Correct. Absolutely. Yeah.
So, so with that like, what are the, like, say, things like there are intangibles that come into play, whether it is IP, or how do you bring those into, like, it could be, say, we are dealing with, especially at CIE, we are dealing with early stage startups. Most of them they come in when they're still pre-revenue, and then they're with us through early revenue and early scale, and then they outgrow and leave. So most of them are in that stage. In that stage, how do you kind of to communicate that this IP holds value, or the customers have got, because it's not just about 5 customers and like 25 lakhs revenue. It's about 5 customers that clearly demonstrate that I will easily get 50 of them in the next 1 year.
Mm-hmm.
How do you play with some of these things to demonstrate? Because at the end of the day, you have to prove your potential. You have to prove where you'll be 1 or 2 years from now. Because every investor is looking at the next 18 to 24 months horizon. If you can show what delta you can create. So how do you use IP and some of these things to kind of demonstrate that value?
So here, Ramesh, I would say that I think...
So I would like to now request you to speak from the other side. If you're listening to this from a startup, what would you like to hear? If you're an investor, which is the role you played mostly when you in different organizations, if you're listening to a startup, what all would you like to hear? that will convince you that like the future potential is good?
So I would, one thing I would say from the investor perspective is that because the investors are seeing hundreds of startups, monthly, so they have, they are seeing not only your idea, but they're seeing so many ideas out there. So you have to be really talking their language, and secondly, talking as you said about the IP. It has to be so convincing. Your use of technology or your use of you know the uniqueness has to be so compelling that the investor gets attached to the idea. So as I said, from when as a startup, if I so if I'm speaking from a startup perspective, when I'm convincing them about the idea, I have to show some level of market research. I can't go with empty hands about having no idea about what the market is. So if I'm, let's say if I'm targeting influencer marketing, I'm just taking one example here. So what is the reach that I'm going to what are the reach these influencer marketing professionals have? How can I add value? How can I what are the things that I'm going to offer? 5 things that I can offer to them, and how will I monetize that? So no matter how great an idea is, if there's no monetization plan, there's no revenue plan, then obviously the investor will keep on asking questions, and you can keep on going back and forth, and you'll reach nowhere. So you have to be ready with the market research. You have to be ready with data that will speak for itself. You have to have a monetization plan. So one is to have a great idea. Then obviously a lot has to be, how will you execute that idea? How will you put that idea into action? And then once you start showing that this is my execution plan and this is the detail I have set for how will I, in the first month I'm going to achieve this, in the second month this is how my marketing will start, in the third month this is how I'm targeting to increase my geographic presence, and in the fourth month these are the additional set of customers I'm going to reach. So there has to be a plan for and see, every idea starts with a thought, but unless you have a detailed plan, and the devil lies in the detail. Unless you're detailed about how you're going to achieve what you're talking about, whether you're talking about reaching 100 crore revenue after 5 years, or having let's say 100,000 customers after 2 years, how are you going to get there? And needs to be broken into steps, and I need to we need to see the whole plan is there, and we're not talking to a person who is, who has a great idea but who doesn't know what to do about it.
There should be very tangible. When you say like, okay, this web will be a year from now, it should be something that is believable, meaning it's well backed by data. So there are a couple of questions, Vineeta. So somebody has asked, it's a product. If a product is in market from 2 years and revenue sees upward graph only during seasons, it's a seasonal product. But still they use the low season to build their features and high season to kind of get the revenue. We test over 2.5 lakh users so far and revenue of about 40 lakhs in less than 2 years. Can we raise funding? I think I know the answer, but we would still like to hear from you.
Yeah, sure. Why not? You can raise funding. And if you're able, achieving a 40 lakh revenue is a good, at least you're getting there and you're increasing. Now, again, how will I evaluate will again be based on, how much revenue can I see happening over the next 5 years? Because we normally project 5 years in future and see if it's going to have, let's say, 20% or 25% growth. Now, it doesn't matter. It might be seasonal. It might be that, only in the festive season you have the demand, or only in, let's say, the academic season when, your colleges are opening up, you have the demand. But if it's that still has a multiplier growth at that time, obviously you'll get a good multiple good valuation. But if it is a slow growth, the valuation will be less.
That predictability is seasonal is okay, but predictability should be there. If we have to predict that it's growing, yes. The growth projection should be there. That is more important.
Correct.
So there is another question. What will be your advice for startups with products that are focused on public health with governments as primary paying customers?
There are a lot of products like that, and I'm not saying that if your government is your primary customer, that the valuation will be any less, because government is also updating its technology use.
I think this question is coming from the fact that most advisors, mentors, especially in the city here, but in India in general, if a startup is predominantly depending on government, the risks are very high. I think the question is coming from there. I mean, will that risk play against them when they go to raise funds?
See, obviously, government is a difficult customer, and it might, pay you over a longer stretch of time. So the customer risk is high here. But even with that, I think the government right now is so proactive in updating itself, whether they're updating their, surveillance technologies, railways is updating its technology. So everywhere, government is also trying to keep pace, and they are updating their technology use. So no, I mean, I won't say that government is a bad customer, but just that it is a difficult customer, and that much risk to your customer.
So if it's a technology-based play, it's a value-based play, then it's okay. So the assumption is again, like, one is the risk with the government, and the other problem with the government is like people think you have to be dirty to deal with the government. Right? I mean, you have to play the system and like, so, but if you can convince that you're coming with from value, like the examples you cited, you around surveillance or like some of the railways and such. If you're coming from a clear technology value, then I think it is still credible. And if you demonstrate that you can get revenue from them, money in the bank.
True.
I think that's all at the end of the day, that's all matters. I mean, government or not, like you said, is incidental. Revenue is revenue.
Yeah, correct.
You can demonstrate the revenue.
Some strategic relationship here will play its part.
And I think this one was part of another question, but I think it's very relevant. Year-on-year growth. So, like, I mean, if you take the case of the 40 lakhs, if the 40 lakhs happen like equally over the last 2 years, they're not as exciting, because which means next year might be only 20 lakhs. And like if it is, but the 40 lakhs has happened where it was like 1 lakh in the first quarter, 2 in the second, 5 in the third, and like right now it is like 20 lakhs happened in the last quarter. That is showing a healthy. So I think the year-on-year growth is a year-on-year or quarter-on-quarter growth. Is an important factor, right? In demonstrating future potential.
So instead of taking the yearly revenue, we can also take the average run rate. So how you're growing, that will affect. So I mean, you answered the question. So
the plot is important. They should show that it is growing.
Yes.
It's not just the 40 lakhs in last 2 years, but based on the current trends, it's going to be like 120 lakhs in the next year.
Yeah, correct.
That's the more important thing to project.
Absolutely. What will it be in future? Because your multiple is based on the future. So if you can say that 40 lakhs is last year and next year it's going to be 80 lakh, we'll evaluate based on 80 lakhs.
So I think we have run out of time, but this question is a good last question. I think it's also going to summarize the whole discussion. Can you brief out what are the factors to consider for value proposition? This value proposition, I read it as valuation, but maybe we'll take it as valuation. What are the factors that go into valuation? Just to summarize the whole talk.
Okay, so I mean, just to summarize, I would say when we are looking at, we either look at pre-revenue companies or post-revenue companies. So post-revenue companies are still, simpler. You can use DCF, and everyone, is now kind of aware of what it is. It's the present value of future cash flows. You can use comparables. So companies with a similar background, how are they valued in market if they are in the same space and they are traded, or they've been, there have been some acquisition, or there has been some fundraising by them. So revenue multiple, EBITDA multiple, or it can be, monthly active users. Let's say in case of Netflix or something like that. And then there is a combination of method which is called a first Chicago, which is you apply a probability to your best case, average case, and worst case terminal value. And based on that probability, you arrive at a valuation. So the pre-revenue method is where it's more complex and the numbers are not there and you can't really project, is where you give intangible things value. So the first method, the most popular method is the scorecard method. So you have, you can have a scorecard points of, 10 points or 15 points, and every point, let's say, technology. So you give that a score out of 10, and then you add up the scores, and let's say my added score is 7.5, and then I multiply that with what is the average multiple of average valuation of similar startups. So if the average valuation of similar startups at this stage was, let's say, 10 crore, and I multiply that by 7.5, I arrive that, this startup should be valued at 7.5 crore. Then the other method and simpler method, so scorecard has like 10 and 15 points, as much as you want. The simpler method is called a Berkus valuation method, which has only 5 points. So you have idea, management team, MVP, strategic relationships, and sales. So just these 5 points, you value each of them at 1 crore each. Idea is great, I'll give you 1 crore for that. Management team is not so great, okay, 80 lakhs for that. And similarly, you give everything and you add up. So you might end up with a valuation of, let's say, between 4 to 5 crore in this case. So this is just when you're at an idea stage and you don't have revenues. The other is a risk summation, risk factor summation. So you highlight how much is the risk of getting into that startup, and you can, again, in this method, you can have 5 risk or you can have 10 risk, and you give each of the risk as a +1, -1. The team is great, I mean, no risk there, so you give them a +1. There is a lot of competition, you give them a -1. Again, you add this score and you multiply it by the average valuation of a similar staged startup. And the last one is a venture capital method, which is what mostly we use, which is based on what is the terminal value that the venture capital will exit at, and how much target return I want to see. So if I'm assuming that I'm going to exit in 3 years, and at that time the valuation will be 50 crore, but I want a 10x return. So today I will value it at 5 crores. So, simple, based on, and obviously I'll take into account, dilution happening between today and in 3 years. So that gets adjusted for. But if there is, let's say, assume no dilution, then it's just basically terminal value divided by the return that I'm looking at. So these are some of the methods that investors use, and I mean, they might sound complex, but obviously each of them takes into consideration about what the startup is presenting based on their plan.
Some level, this is all drawn from historically looking at multiple startups and how they've evolved. Right, some of these heuristics have evolved from there. Yeah. It's very hard to project how startups will grow, or any specific startup will grow. So you just look at some aggregate models and derive what factors led to that growth, and then I think that's what these all various models are trying to model from that. So, but I think it does give a good framework, because even startups struggle to understand what their value is sometimes.
Correct. Yeah.
And so they just go with the norm, saying, "Look, every startup is raised at this value, so I will raise." They maybe they're underselling themselves.
Yeah.
Startup raising 1 crore at 7 crore valuation, maybe they're underselling themselves. They could do 2 crores for the same valuation at 10, 15 crore valuation. I mean, for the same equity. So I think the underselling is the biggest risk. If they don't know these things, I think that's where they need to be aware. So just to see, like, are there any comparables? So Vineeta, thank you so much for joining us today. This is a series that we hope the startups in the city, and it all goes online, so even elsewhere, but definitely startups in the city benefit from the insights that helps in their operations and functioning. So Vineeta, thank you so much. This is something that's on everybody's mind. I mean, I don't think we can do this too often. Anytime we do it, there is interest when it comes to valuation and how do you raise money. So I think this was very good. Thank you so much, Vineeta. Thank you for joining us.
Thanks so much, Ramesh, for having me. Thank you.
And all the best with the fund.
Thank you so much.
Thank you. Bye-bye.
Bye-bye.